guys, welcome to this Money Control live stream. You're watching Morning Trade with me, Nandita Khemka. It's the last trading day of 2023 and looks like we are poised to end the year on a high. We'll have to see whether or not we manage to make a dash at that 22,000 mark or not. If that happens, of course, the bulls will, of course, be ending the year on a high. But lots of cues to digest this morning. GIFT Nifty is hinting at a start above that 21,900 mark. Lots of stocks in focus as well. And of course, we'll also be taking up all your stock-related queries on, with our expert on the show. So if you have any queries, keep them coming on our live feed on YouTube, and we'll try and take them up. But before we do that, let's take a look at the top headlines at this hour. Stocks closed mixed on Wall Street as Dow and S&P closed with gains. The S&P 500 is now just about 0.5% from hitting record levels ahead of the last trading day of the year. Asian markets open mixed on the final day of the year. The GIFT Nifty is, however, indicating a start above that 21,900 mark for the Nifty. Crude prices crack. Brent falls over 3% to under $78 a barrel as concerns over shipping disruptions in the Red Sea ease, with major shipping companies resuming operations in the region. RBI's financial stability report is sanguine on bad loans. Baseline projection expects stressed assets in the banking system to hit 3.1% by September 2024. Even under a severe stress scenario, bad loans are likely to rise to 4.4% of the total assets. Among stocks in news, we put the spotlight on Federal Bank, RBL Bank and Tata Coffee, among others. Well, let me first get on board our guest for today. Joining me is Sahil Kapoor, who's the head products and market strategist at DSP Mutual Fund. Sahil, great to have you on the show. Season's greetings to you. The kind of up move that we have seen on the markets, we are poised to end the year on a high, right? But I was reading a report from Kotak yesterday, and they said that investors must temper their expectations from 2024 because all the good news seems to already have been baked in. What are your thoughts? Do you think we have kind of topped out and perhaps 2024 will be a year of muted returns?
Hi, good morning and season's greeting to all of you. So I think when we start the year with very strong expectations, of course, we have a large YTD year in 2023. Plus also we are trading at very high valuations in terms of our own history. If you look at Nifty or the broader market, most of the clusters of stocks are trading at 80% plus percentile of their top valuations. Right, so it does make sense to temper down expectations. Historically, what we've seen is that when Nifty trades at 22.5 or 23 times trailing earnings, forward returns are usually slightly muted. So it, I think, makes sense to look at market more cautiously from where we are today. But as you've seen that there are a number of sectors and stocks which have participated in this market. So I think it can maybe continue for some more time, but it does look like that we might hit a air pocket phase of consolidation or correction as we go into 2024.
Right, expect a phase of consolidation as we step into the new year. But let's also talk about the broader end of the markets. Lots of exuberance there. 45%, 54% kind of up move. On the mid and small cap indices, respectively, on a YTD basis, right? But do you think the exuberance will continue despite the kind of valuation froth building in some pockets?
So largely the answer to that question is I don't know. It's very hard to say whether this will continue or not. There is no way to judge whether this move will continue for longer or not. But let's look at some data points from history. When you look at let's say the top 1,200 stocks which are listed on NSE and BSE, they have about 1,000 crore plus market capitalization. And if you remove the top 500 stocks and look at the rest of the 700 stocks, on an average blended basis, the price to earnings multiple is somewhere about 40, which is very, very high. Now compare this to history. This multiple usually is between 22 to 23. So we are trading at a significant premium. Second, when you look at earnings growth for the broader market, it has come in very, very strong this year. Almost 24% earnings growth is expected for FY24 on the whole. But just look at the last 2-3 quarters. Except consumer discretionary and financials, there is no other sector which is reporting high double-digit sales growth. Sales growth has already it's getting closer to low double digits, right? Between 10 to 14%. And our expectation is that number will also fall. Second, if you look at the broader market, the BSE 500 universe, you will see that the PAT margins were at 13%, which is, I think, about a 13-14-year high that we've ever seen. So I don't think there is any significant uptick which is left for margins from here, and sales growth is slowing down. So earnings growth can take a hit from where we stand today in the next quarter. So the question to ask is, if we are going to grow earnings at 10 to 12%, should we be trading at these multiples? So for that, I think market will try and adjust multiples lower. That is why I think it has to be taken with a pinch of salt, this current rally. You have to be more cautious.
Well, of course, caution is the word going forward. Talking about particular sectors now, Sahil, NBFCs, what are your thoughts there? Because, we've seen two crackdowns coming in from RBI. First on, easy loans, and secondly, on exposure to AIFs as well, even though that's not a recurring one. But going forward, do you think NBFCs should be on the shopping list given the kind of valuation comfort they offer, or do you think this pocket is an avoid at the current juncture?
So BFSI is a sector where I think we have a lot of comfort. When you compare, let's say, if you put all the sectors in pecking order, BFSI comes at maybe number one or number two in terms of the overall underlying fundamentals. I think the earnings trend is very strong. As I said to the reply of the last question, the second sector, or I think the highest earnings growth that the sector which is seeing right now is financials. And lenders, of course, both banks and non-banks, they continue to report very, very strong numbers. And this is happening at a time when their asset quality is very good and getting better. And secondly, I think the cost of capital has also not significantly gone up. So on the whole, I think they will probably have good NIMs, not the records that we've seen in last 2 quarters, maybe slightly lower, but growth rate remains very, very strong. So I suppose lenders, whether it is banks or non-banks, will continue to do well. It's more like a 3 to 5 year cycle. And we expect this sector to do better than the market overall. It is growing at a faster rate than the overall market. B, it also has better valuations. So if you look at, let's say, Nifty Financial Services Index on the whole, compare it to its own history, it's trading right at its long-term average valuation, which is a far cry from where the rest of the market is trading. So I'll be more constructive on this sector. And if at all there is a strategy to buy on dip, I think this is a sector to look forward to.
Would you say the same about IT stocks? We've seen Infosys, a large deal getting cancelled there, but the sector per se has run up quite a bit in the last 1 month, especially since Fed indicated that it could look at 3 rate cuts next year, right? So, one camp believes that this is the right time to buy IT stocks given the fact that valuations are near long-term averages. Would you concur with that thought?
So let's look at 3 data points, 3 indices, NASDAQ, semiconductors SOX, and NSE Nifty IT index. Look at their peak valuations that we saw in last 2 to 3 years. So NASDAQ peak valuations were about 35 times, end of 2021, beginning of 21. SOX again, mid of 21, end of 21, went to 35 times. And Nifty IT index peaked at about 34 times, at the similar juncture. Currently, all the 3 indices are trading at 30 plus in terms of price to earnings ratio on a 1 year forward basis. So we are getting back close to those peak valuations. And historically, we've seen that if the sector is growing at 8 to 10%, which is what even the most positive companies are guiding for, it is going to be very hard for the sector to continue to perform very well. So my guess is that IT needs a healthy dose of correction, or a large consolidation where earnings continue to, march forward and go upwards over time and stocks consolidate for a while. But I think it's a sector where it has a very, very strong long-term promise. There is no doubt about it. One of the only sector which has delivered 15% bottom line CAGR. But I suppose you can't pay 32 times for 10% growth, which is maybe temporary for the next 8 to 12 quarters. But it's going to be hard to justify those valuations. And therefore, I think it is more logical to await a correction in this sector than to be very aggressive.
All right, that's the view on the IT pack. But, I really want to get in your thoughts on the power sector, right? Again, alluding to that Kotak report that I was mentioning at the start of our conversation, Sahil, Kotak has flagged off that the narrative on the likes of NTPC keeps changing on markets' whims. Do you see value in some of these stocks like NTPC? Do you think, or do you think it has run up quite a bit ahead of its fundamentals now?
So largely, I would say that there has been a large rally which has sort of discounted the best of things that can come, right? So let me put it that way, that we've extrapolated the best of the future today. And usually we've seen that that leads to disappointment when those expectations are not met. So in this sector, we've seen a number of companies have seen significant run-up, and the earnings are yet to catch up. And I think that exposes investors to a lot of risk of just getting those expectations right. So I'll be more cautious, and I think there are other sectors where the expectations are very, very muted and earnings promises are much more stronger. So I will probably go and hide in those sectors rather than looking at sectors where next 3 to 5 years are cooked into the prices. So historically, we've seen that these expectations generally either don't get met. Even if they are met, the returns are usually muted because you've already paid for them.
All right, that's the view then on the power sector. But, a couple of more questions, Sahil. How would you be looking at the EV theme, in entirety? Maruti, Tata Motors are upping their games. Now, there are reports that Tesla may open up its manufacturing unit in Gujarat. So, listed player, Sona Comstar is the only, supplier to Tesla, which is listed in India, right? So how would you play this entire EV theme now? Would you play it through stocks like Maruti, Tata Motors, or would you look at something like a Sona Comstar?
So I think it is still a very uncertain environment in this sector. One thing is clear, that there is a long-term trend which is getting established. There is no doubt about it. The whole fleet is going to get, replaced over, I don't know how many years, maybe 10 years, 20 years, or 5 years. Nobody has an idea. But the idea is that it will happen over time. Now, there are two ways to look at it domestically. One is to play OEMs, right? The car manufacturer themselves, or to play the auto ancillary, gamut. Domestically, the biggest input that goes into an EV is the battery. We don't manufacture that as of today, and we don't have the infrastructure or the intention to do it over a period of time. So you get two types of play. One is OEMs, the other is the frills players, right, who are supplying the mirrors and others and fenders. I think they are great plays. Their profitability can be significantly strong over time, and that segment, I think, is probably one of the most promising. Second is, of course, the OEMs. I think that is where, in certain parts in the sector, the valuations are very, very attractive. Over time, many of these companies are cash rich. Of course, they don't have much debt. The numbers have started to improve only post-COVID. So case in point is, for example, if you look at passenger vehicles, X of SUVs, for the last 10 years, the headline numbers are same. If you look at two-wheelers, for the last 10 years, headline numbers are the same. And now we are seeing that because of this replacement, their demand numbers are bound to go up over time. So this is one sector where we are, very constructive, positively oriented for the next 3 to 5 years. But from a sense of what to play right now, I think the clarity will not be very high. It will be a selection of the best players from OEMs, all the three segments, whether you're looking at two-wheelers, four-wheelers, MNHCV. MNHCV not so much in terms of EVs directly, but yes, overall. And then partly from auto ancillary plays. So the idea is that there are tailwinds for this sector. Each of these segments have players which are very, very strong from in their business orientation, and you pick these right players and then ride through the sector, and then probably narrow down over time rather than narrowing down today.
All right, that's the view then. With that, Sahil, afraid we are running out of time. Thanks a lot for taking our time and joining us. I wish you a very happy New Year in advance and look forward to more conversations with you in the new year.
Thank you. Happy New Year to you. Thanks.
Thanks a lot. Well, with that, let me, bring on board a technical expert on the show without any delay. Joining me is Raja Venkatraman, who's the co-founder of NeoTrader. Great to have you on the show, Raja, this Friday morning, last trading day of 2023. Do you want to place your bets on the index making a dash at 22,000 mark today?
Yeah, good morning, Nandita, and season greetings to all the viewers and you as well. And what I would like to concur here is that last week when we had spoken, I had cited historic evidence that prompts towards revival on the Nifty. And the charts unfolded, we have seen a revival from the last dip which we saw on 20th of December, and it continues to edge towards 22,000. But then what one must understand here is that this entire month we have seen more than around uh, almost around 1800 points rise from the lows, so which is quite significant. And when you are trying to wager for more rise ahead, one also has to understand that there are going to be dips along the way. So, like I have always been maintaining that I am going to be a perma bull. Yes, the bullish trends will continue, and what we are looking forward in the next month, which is the January, we are expecting the Q3 result season to begin. So that would add more flavor to the current trends as well. So overall prospects continues to remain higher, and we would definitely see 22,000 edging out. But I don't think that's going to happen today. So today you may see a brief uptick and then probably a profit booking considering the last trading day of the week. But then I continue to believe that the trends would remain to the upside. Use dips towards the 21,700, which is also the maximum pain point where there is decent set of supports building up on the options front as well. So overall, almost all the sectors are firing in, and especially the PSU related ones are the best bets right now, and the banking space. So these are two sectors which are doing quite well. And the other space is the metals, which are doing quite well. So these are some sectors which I will continue to look for as an action pack for today. But then if you're looking ahead into the next month, I definitely see 22,000 being exceeded. And one of the main reasons which I believe is Bank Nifty. Bank Nifty, like I have been maintaining, that they have never really performed and given us an opportunity to participate. And now what has happened is that the strong rise which we saw a few days ago post the state election results, the Bank Nifty has continued to show some steady progress. But then the progress has not been as vociferous as Nifty. So we'll continue to maintain the bullish poise on Bank Nifty, but then it's going to be step at a time. And with the current consolidation being given up at around 48,000, so we can continue to maintain that yes, in the next month you will see a 50,000 being achieved in Bank Nifty as well. So good momentum plays emerging even in the mid and small cap space. So overall, there is a very nice bullish momentum going on. So those who are considering, maybe the markets have gone up too high, I should look to short it at current levels. I would say that please leave those thoughts aside and look at dips as a buying opportunity rather than as a selling opportunity.
All right, look at dips as a buying opportunity, and of course a whole host of sectors that Raja mentioned will be of course in focus. But let's talk about the OMC basket. Crude overnight has tumbled 3%. $78 is where Brent is at, and of course there is buzz that we could see a reduction in fuel prices as well. Of course these are all report based, but we're getting quite a few queries on the likes of IOC, BPC, HPCL, in fact even MRPL and Chennai Petro. Anything that's catching your fancy? KRK Rao wants to know your thoughts on the OMC pack, and we have another gentleman, Pawan Yadav, wanting to know particularly about IOC. How would you, approach the entire OMC and energy basket now?
So when you talk about the OMC baskets, all the stocks are looking good. But then amongst them, I would definitely favor HPCL, because HPCL is having better capex, and their GRMs also were reported quite well. So I continue to believe that HPCL is a much better bet. Now, if you wanted me to give you a ranking, then I would say HP, then BP, then IOC. So these will be my ranking as far as the OMC packs are concerned. And like you rightly mentioned, with the fall in crude oil prices, these stocks are once again showing some steady upward traction. So one should look to buy at current levels, buy on dips, but then these stocks looks promising for the next few days.
All right, stocks looking promising. We were talking, in fact, you mentioned Nifty Bank Index as well. Of course, ICICI Pru AMC has got the approval from RBI to buy 9.95% stake in a couple of banks, IDFC First, RBL Bank, as well as Federal Bank. Any of these banks warrant a look from a trading perspective? We have a lot of queries on some of these names on the feed.
Right. So amongst the banks names which you mentioned, I believe that Federal Bank is poised for a move up right now. It has spent sufficient time in consolidation and with some positive news flows and with the banking space continuing to hold on to higher levels. I think that there could be a opportune moment emerging in Federal Bank, and the risk element in this is also quite affordable. So one should look at Federal Banks from a buying perspective.
All right, Federal Bank, looks good from a buying perspective. Let's take up some other queries then. Jeevan wants to know your thoughts on a JSW Infrastructure, Raja. Infrastructure names have been doing well, right? But particularly on the charts, when it comes to a JSW Infrastructure, how would you view this, for a trading perspective as well as an investment perspective? Yesterday, it was down 0.5% or thereabouts. And, over the last 5 sessions also, it hasn't really had a fairly good run. So, should one look at other infrastructure names compared to this one?
Yeah, so JSW Infra, it had its fair share of run, but then what has happened in the last 1 month is that when the markets were edging out new highs, this stock has actually come down, and the infra space continues to remain mixed. So if you're a holder in JSW Infra, you can keep a stop loss below 205. And if you want to freshly invest into this stock, then this would be not a good candidate to consider.
All right, that's the view. Not a very good candidate to consider. Hope that answers your query. The next one is coming in from Dhananjay on an MRF. Now, this stock is at a 52-week high. In fact, yesterday itself, it has rallied 4%, and the last 1 month, 13% kind of gains. Which is the next key hurdle you'll be watching out for on this one?
See, when we're talking about MRF, it has gone beyond everyone's imagination. So those who are already, having this stock, very good for them. The stock continues to create new highs, and this stock, if I may say, there is no ceiling at the moment. So the stock continues to create new highs. There are dips, and those dips are being only bought by people who are having high net worth capital. So now, if you are asking me whether this stock has got prospects to move higher, the answer is yes. And what target I would expect? So the target is an open-ended area. So I would not like to comment on the target because any target here seems meaningless at the moment.
All right, that's the view on an MRF. But just about a couple of more queries to take up. Gaurav Sharma wants to know your thoughts on an IRCON. He wants to know whether this is the right level to buy into this stock for the long term. Of course, railway stocks have been, in an upward trajectory. In fact, they've been the flavor of the year. So, going forward, wait for dips or ride the momentum right now itself?
Yeah, so when you are talking about the railway stocks, not all the railway stocks are showing that fire under their belly. So, IRCON, I would say in particular, has not really been able to generate that kind of momentum. So, if you're really looking to participate in a railway stocks, look at some stocks like RVNL, which is a much better play, and that would give you a more traction. Now, with the budget also coming up, I think that RVNL is poised to move higher. So, only thing, a caveat here would be that these railway stocks don't go up all the time. So, if you have the patience, then go into a railway stock. Otherwise, there are other sectors that are doing better. Now, railway stocks, yes, they have the tailwind of the government news flow and the additional infrastructure which they are going to build in. But then the problem is that these moves will be very limited, and then the stagnation period will be longer. So that is what one should consider while going into such sectors.
Right, really last query for the day and for the year as well. This one is on a Nestle India. I think who's sent me this query? Littlewood, somebody with the name of Littlewood has sent me this query. Nestle India, of course, Jan 5th is the record date for the stock split. Yesterday, the stock hit a fresh 52-week high. Should one take positions before the stock split or wait for that to play out and then enter the stock?
Yeah, one could continue to play for the stock split because the overall momentum in the stock is quite good, and the consumption sector itself has been very slow moving, and right now we are seeing the moves in, say, Nestle, in Britannia, in Colpal. So the move is coming up quite well. So maybe the consumption sector, which was on the sidelines for a while, is now stepping in. So that could be a good space to consider. So one should buy at current levels and look after the stock split and consolidation and invest a balance. So maybe you can have a split in your allocation and go in for Nestle.
All right, that's the view on Nestle. Of course, this wraps up our query segment for today and for 2023 as well. But before I let you go, Raja, what are you recommending for our viewers in terms of stocks for today?
Yeah, so I would like to go in with two stocks. The first stock is a buy in Tata Power. Tata Power, a buy at current levels with a stop loss at 328 for a target towards 339 and 342. And the second buy would be in Zydus Life and around 693 with a stop loss at 683 for a target towards 702 and 710.
All right, those are the recommendations coming in from Raja. Well, with that, of course, Raja, thanks a lot for taking out time and joining in. Wishing you a very, very happy new year in advance. And I'll see you on the other side in 2024.
Sure. Bye.
Well, with that, we've come to the end of this edition of Morning Trade. Of course, it's a, thank you for watching from me and the entire team that put the show together. Wishing all our viewers a very happy new year in advance. And of course, we'll be back with Morning Trade on the 1st of January as we kickstart, trading on a brand new year. We'll have to see, of course, whether we manage to clock that magical 22,000 mark in today's session or not. If that happens, of course, it will be like an icing on the cake for the Indian markets. But stay tuned. Coming up next is Opening Bell.